And as we were saying at the last part of last year, people were saying, you need to declare victory, this is over. And then we had a quarter of inflation, which was well above 3%. So we want to be more confident. And frankly, because the U.S. economy is strong and the labor market is strong, we have the ability to take our time and get this right. And that's what we're planning to do.
When Powell says the U.S. economy is strong, he's quite delusional. It's all an attempt to prevent the house of cards from crashing down on Biden after the disastrous debate a few weeks ago. He really can't afford for the economy to collapse. The global bond market is signaling that the world economy is on shaky ground, with U.S. bonds foretelling doom and gloom. Even China is trying to reverse their bond market to prevent another SVB banking crisis. Let's focus on the U.S. first, because it is the world's largest economy, and the problem here is even more significant. The situation in the U.S. Treasury market is looking very dire. Over the past 2 days, bond yields have crashed after a significant spike a week ago. The 10-year yield has dropped by almost 15 basis points, a substantial move in a short time. When bond yields drop, it means there are more buyers than sellers, indicating more money is entering the bond market. This tells us a lot about America's dire fiscal situation. Biden is funding 2 wars, one in Ukraine and another in the Middle East. Meanwhile, Yellen is borrowing vast amounts of money at higher interest rates, pushing the deficit to insane levels. The Congressional Budget Office expects the U.S. deficit to hit $1.9 trillion this year, or 7% of GDP, $4 billion more than the previous forecast. This spending pushes the U.S. government closer to an eventual default, which will end badly for all holders of U.S. bonds. This raises the question, why are yields going down? Shouldn't bondholders be dumping their U.S. treasuries like hot potatoes? On the surface, it doesn't make sense, especially when considering the macroeconomic picture. Global currencies are tumbling, and countries like Japan are on the brink of selling their U.S. bond holdings. The yen continues to depreciate against the dollar, now over 160 yen to the dollar, showing it's losing buying power. The worse the yen's collapse gets, the higher the odds of an intervention. Japan has intervened at least 3 times, dumping tens of billions of dollars to save the yen. Given this, money should be fleeing from U.S. treasuries. If Japan dumps a boatload of bonds to raise dollars, it won't be good for bond investors. Supply will increase and bond values will crash. But why are people still piling into bonds? The answer is quite simple. The U.S. economy is in real trouble, and the signs are becoming increasingly hard to ignore. The biggest warning signal just appeared. U.S. services have contracted at the fastest pace in 4 years. This is a significant problem because the U.S. is a service-based economy. Apart from manufacturing and agriculture, about 70% of U.S. GDP comes directly from services. So, a contraction in this sector is extremely bad news. When Germany's manufacturing started to collapse, it was clear a recession was imminent, as that sector is the beating heart of their economy. Applying the same logic to U.S. services, we are facing a serious issue. The services index has dropped below 50, down to 48.8, indicating contraction and declining demand. Both new orders and business activity are also in contraction, with new orders falling to nearly 47. People simply aren't consuming anymore. Prices in the U.S. are too high, and salaries aren't rising fast enough. The U.S. has a spending problem. Despite the deficit being 7% of GDP, the money isn't being allocated well. It's used to fund foreign wars, build the military-industrial complex, and fight a trade war with China. The supply of goods isn't expanding, but the money supply is, causing prices to rise. Just ask the guy who bought a Diet Coke for nearly $10 at Six Flags. That's how bad things have gotten. People are spending less, and if this trend continues, a U.S. recession is on the horizon. Another sign we can't ignore is that consumers in the U.S. are going broke. People are relying on credit cards to pay for necessities, but even that strategy is hitting a wall. There's a payment crisis building up. 11% of people are 90 days delinquent on their credit card payments, and auto loan delinquencies are climbing towards 3%. We're heading closer to the levels seen just before the 2008 financial crisis. Bond yields collapsing in the U.S. reflect this economic reality. Consumers are in trouble, and two big events might be coming. The U.S. could plunge into recession, or the Federal Reserve might slam rates down despite the ongoing inflation crisis. Both scenarios are bad, and this is why money is still flooding into U.S. bonds despite the government's crazy spending. To get confirmation, we just need to look at the money market funds. Capital is still flowing in, hitting a staggering $6.2 trillion in short-term T-bills. This isn't a sign of strength. Money is hiding in bonds because the market recognizes the dysfunction in the real economy. Things are not well, but let's shift gears a little to China. The Chinese government is also facing a challenge in their bond market. Like the U.S., too much money is being poured into long-term bonds. This might sound a bit strange. How is this a problem? China's inflation is low, and the West frequently cites Beijing over deflation, so shouldn't lower yields in China be a good thing? Ever since the housing bubble popped, Chinese investors have been piling into long-term government bonds, causing yields to drop from over 3.5% to around 2%. The psychology is simple, with prices stagnant or declining and inflation at just 0.3%. Locking in a 2% to 3% rate is phenomenal. It guarantees purchasing power and a return compared to real estate or Chinese stocks. However, this creates a problem. Money is getting locked up in the bond market. The Chinese government wants capital to flow into the real economy, not get stuck in bonds.
But it's actually, the job market isn't that bad right now. You can still get jobs. What a bigger problem is, frankly, Steve, is that salaries are low. So if people are asking for, say, 10,000 RMB 3 years ago, they're now asking for 8,000 a month in starting salaries. So starting salaries have dropped 15 to 20%, which is why you're seeing the D word, or deflation, is flaring up its warning signals into China, because consumers are still trading down, cutting back on big ticket items.
China has the opposite problem of the U.S. While America is fighting to bring inflation down, China needs to raise inflation a bit. As the East and West decouple, China needs to become more self-reliant, which means increasing domestic spending. The U.S. and Europe are hitting Chinese exports with a lot of tariffs, and the best way to counter this is to boost local spending. This chart illustrates the situation well. China's industrial production is thriving, producing cheap EVs and exporting them to mitigate the crisis. However, retail sales are still lagging behind. Shifting the psychology of consumers won't be easy. U.S. consumers love to spend, but Chinese consumers prefer to save money. This is why the government is preparing to intervene in the bond market. To address this challenge, China's central bank needs to flood the market with bonds. There are two main approaches to achieve this. The first, similar to Janet Yellen's strategy, involves issuing a large volume of new bonds to borrow money. However, this would only exacerbate the national deficit, a path China wants to avoid. Did work? The second approach is to sell existing bond holdings to the market. Here lies the problem. China doesn't have sufficient bonds in reserve. Unlike the Federal Reserve, which holds over $8 trillion in U.S. bonds, the PBOC isn't a major buyer of its own government debt, owning only around 1.5 trillion yuan, which is roughly $200 billion worth. The remaining option is for China to turn to state-owned banks and borrow their bonds to flood the market. This approach avoids increasing the national debt directly, although it incurs borrowing costs for the state-owned banks. To implement this, the PBOC has entered agreements with ICBC and China's Postal Savings Bank, which together possess over 10 trillion yuan in bonds, equivalent to $1.4 trillion in firepower. This move aims to increase yields and curb speculation as the central government seeks to stabilize the market. In recent months, Beijing has issued over 10 warnings to investors against speculating in Chinese bonds. The last thing China needs is a banking crisis triggered by government bonds, as seen in the UK in 2022 and in the US with SVB last year. Learning from these incidents, the Chinese central bank emphasized the need to evaluate the financial market from a macro-prudential perspective. In other words, China intends to closely manage its bond market to avert a collapse akin to SVB. It's crucial to recall the lessons from these events. Interest rates don't remain low indefinitely. Eventually, regardless of the country, they will rise. If banks over-leverage on their bond investments, they risk collapse due to interest rate or duration risks. China's proactive stance aims to mitigate these risks and ensure financial stability. However, the larger challenge lies in channeling money into the real economy. The bond rally must cease, or China's growth will be jeopardized. Unlike the West, China boasts an exceptionally high investment and savings rate, with national savings averaging over 45%. While this is beneficial, excessive reliance on long-term bonds poses significant risks. Too much of a good thing can be detrimental. If interest rates begin to climb, investments could suffer substantial losses, discouraging consumer spending. Imagine if your bond holdings plummeted by 10% or 20%. You'd likely hesitate to make discretionary purchases. The global bond market's signals suggest significant headwinds for the U.S., indicating economic distress and heightening the risk of a recession. For China, reversing the bond rally and reigniting consumer spending is imperative. What are your thoughts? Do you foresee a recession looming for the U.S.? Can China successfully encourage its populace to boost spending in the real economy? Share your insights in the comments below. Stay safe, and remember to like, subscribe, and join us as we navigate through these turbulent times. Thank you for watching.